All right, folks. So, in this class, I'll be talking about the analysis of company financial statements in fundamental analysis. So, for my fundamental analysis, I have two components. I have the looking at the overall economy and the economic conditions that surround the market in which I'm invested. And then I have looking at the individual companies and the individual securities in which I'm invested and looking at their financial statements, um, and kind of dissecting, fine tuning, putting a microscope on what I'm invested in, right? So this will give me an idea of like the x-ray of the company that I'm going to be putting my money on, right? So let's get into it. So again, we're zooming in, we're looking at the health of the actual company. So once you've looked at the economic environment, it's time to pay attention to the potential investments that you're going to make in the market. So if our economic environment is healthy, but there are financial problems within the company, we're still going to see that stock underperform relative to a better run company. So if the economy is a wave and the stocks are like a boat, when the wave goes up, the boat goes up, wave goes down, the boat goes down. At the same time, if there's a hole in the boat, it's still going to sink, right? So, what I mean is choose your investments wisely, right? So, where do I read about company news? Okay, so I have some websites for you guys. Um, I'll either go to Zacks.com, Yahoo Finance, MarketWatch, Benzinga. These are my main, like when I'm studying companies, these are my main websites. Um, and then take a look at what your company profile looks like and if it's worth an investment. Like I'll even go as far as to look at CEO interviews to see what, the leadership looks like. I'll look at, press releases that they have on their website. I really want to get an idea of like what I'm invested in, you know? So, and then on top of this, find the most impactful news about your company. So maybe the company is having trouble holding on to money, or the company has a lot of debt. Maybe they're not growing as fast as other companies in their sector. Maybe their future outlook doesn't look good or not very bright. Um, you want to use, like, I guess, stock trader news. The news is going to help you determine what is affecting the price action. But that general news, CNN, MSN.com, like that, like celebrity news stuff, that's not going to help you. Just because everyone's talking about a company or it's a meme, it's popular, this is not very important in your evaluation of a company. So you have to filter your news out, right? So the most important statements I use and people who invest with me use in company valuation for fundamental analysis, um, there are four main metrics, and they are the company overview, the income statement, the balance sheet, and the cash flow statement. And so, like I said, we go to either Zacks.com, Yahoo Finance, MarketWatch, or Benzinga. There's other apps. Um, there's other websites you can use, earningswhispers.com. Um, there's a bunch of them, but these are the ones that I use for company valuation in my fundamental analysis, right? And these are the four main aspects. So I'm gonna go through the company overview, the income statement, balance sheet, cash flow statement, so you get an idea of what you're going to be looking for. So in the company overview, this has a broad general information, statistics about the company, and it includes information like the company price, market capitalization, which is basically the number of outstanding shares or number of shares that have been purchased times the price of the stock, earnings per share, price per earnings ratio, other general statistics that are good to know. We focus on these. So market capitalization, we want that over at least 500 million, preferably over $2 billion. Um, you want a big enough company, right? It increases the likelihood that you're going to get liquidity in the market and that orders are going to get filled, things of that nature. And then there's enough, movement in the stock itself. Um, Floating shares outstanding or float shares outstanding, that depends on your strategy. If you want a low float stock that like doesn't have a lot of outstanding shares, it's good for like fast movement, but at the same time, sometimes those companies that don't have a lot of shares are also not very popular. And so, or I should say, they tend to be smaller companies or, innovative companies, kind of on the cutting edge. And, sometimes their growth prospects aren't the greatest. But it depends on your strategy. You could pick a blue chip stock that has tons of shares, but it's not going to move as much, but it's got pretty consistent growth, even if it's slow. So it depends on your strategy for number of float shares outstanding. Um, you can look up low float strategies. Um, PE ratio, want that at least under 25, but definitely under 20. That's a good sign. It's basically what you're paying for the company based on its earnings. So if a company's not earning a lot and you're paying a high price for it, doesn't make a lot of sense, right? So you usually want that under 20. That's a good sign. Earnings per share, I want a positive number. I like it at least above 2 to 4. You know, um, it depends, right? But obviously, more earnings um, per share that you can get from a company, the better. Price to book ratio. So the book value of a company is basically if you took all of their like concrete assets, like warehouses and buildings, fleets of trucks and cars. If you took the machinery and equipment they own, everything they own, bulk assets, and then put it all together, you get the book value of the company. It gets tricky with software companies because it's hard to determine like their book value because software is so dynamic and it can be modified. So it's hard to put a price tag on it. But for like traditional companies like Coca-Cola and 3M and stuff, you want, or Unilever and Johnson Johnson, you want, I would look for a price to book of under 10. You want to get more bang for your buck. So you want a cheap company compared to its book value, basically. And then EV is enterprise value. That basically means like it's similar, but it's like you want the whole worth of the company. And this is like how much cash they have, how much physical assets they have, how much intellectual property, like everything put together. Like if you had to put a price tag on buying Amazon or buying Facebook, that would basically be its enterprise value. It's often in the billions. Um, and then the EBITDA is earnings before interest, taxation, depreciation, amortization. It's basically what they earn before they got to pay their bills. And so there's something called the EV EBITDA ratio. And so it's saying if you took the price tag of that company and divided by its earnings, what would it be? And so I want this ratio under 15 personally. Um, Debt to equity ratio, obviously, how much debt do they have versus, what's their equity? So, assets minus liabilities. That depends on the stock. But debt to equity, you want that low, right? You don't want a lot of debt for how much equity they have, right? And then return on equity and return on assets. So, as I said, equity is assets minus liabilities. Assets is, how many money generating things a company has. And you want a return on that. You want profit to be made for each asset for, for that lump sum of equity. So obviously higher values are better, and you can compare companies to competitors and similarly priced stocks and find out if they have a advantageous ROE or ROA, right? There's another one called asset turnover ratio, which is basically how much money can they pump out, how much revenue do they make for each, per asset value. So like, how much can they do with what they have, basically. Sometimes I use that. But those are your company overview metrics, I guess. These are there's a whole bunch of them, but these are the ones I use. Income statement. This tells us revenue, expenses, and net profits. Lets us know if a company is bringing in money from operations or losing money, basically. EBITDA is good, useful indicator on that. Like I said, it's the earnings before they pay all their bills. That's an easy way to remember it. You don't have to get into the details of depreciation, amortization, all that stuff, and taxes and stuff. But yeah, you want good earnings. Revenue is you want that growing or at least not going the wrong way. So high revenue combined with modest assets and a high free cash flow compared to their peers. Those are all good signs. And then expenses. So in some sense, expenses are going to increase as a company grows, but you definitely want expenses to be overwhelmed by their revenue in the end in order to produce a justified profit, right, for investing in a company. And then EBITDA, we talked about this again. We want this metric to be growing. And if it's not, the revenue better be growing if the earnings aren't growing, right? So the only way I'll take negative or declining earnings in a quarter is if the company is bringing in a bunch of cash, right? So balance sheet. This tells us how many assets and liabilities a company has. So how many money generating things or assets a company holds and how many money depleting things that a company holds. So the assets minus the liabilities is equal to your equity, which we like to see growing year over year, quarter over quarter, right? Growing equity, that's a good sign. Assets, we want these to be growing, but within reason. So some assets can turn into liabilities if they require too much maintenance. An example would be like high-tech equipment for production. So we want the assets to be like a 2-to-1 ratio at least to liabilities. And that comes from Intelligent Investor, Benjamin Graham's book. I think he talks about the 2-to-1 ratio of assets to liabilities. That's a good metric to have. And then, like I said, asset turnover ratio, you want that to be high or good. Basically, how much can a company do with the amount of assets they have? Liabilities, we want this to be as small as possible. However, growing companies, just like expenses, growing companies are going to likely take on more liabilities and debt. So these are recurring costs as part of their growth. So it's kind of a necessary evil, but you obviously want your assets to outpace your liabilities so you can have high equity, which is the next point. Obviously, we want that to be positive. And I go a step further to say that we like equity growing year over year. So in a way, it tells us that a company is becoming more efficient. They're managing their cash better. Their money generating things are outweighing their money burning things, right? Um, so, and when you're looking at all these metrics, remember it's good to compare them with peers and competitors so you know where your company kind of stands, and similarly priced companies so you know where your company stands with these metrics compared to other companies, right? And investments, potential investments. And then your cash flow statement. So that's the last financial statement I really look at. So we had income statement, balance sheet, and cash flow statements, the last one. So and company statistics, right? Company overview. So cash flow statement, how cash is moving in and out of the business. We want to see a high free cash flow because it tells us the company has liquid cash at its disposal. So an important thing to note here, operating cash flow, investing cash flow, and financing cash flow are the main types of cash flow that are measured here. And then my favorite is free cash flow, right? So I don't pay too much attention to um, investing cash flow and financing cash flow because it gets kind of murky because of buying and selling share buybacks and you know selling off distributing dividends and all this stuff, and it gets really complicated doing looking through all the calculations for those. But you want to make sure your operating cash flow is good. That's how much they make off of basic operations in the business. And then free cash flow. So if that number is consistently positive, it's very attractive because that represents kind of a reserve of money, a bulk sum of money that could theoretically be used for whatever the company needs to fund growth initiatives without a company taking on more debt. Um, it's a powerful metric to describe a company's credit score, so to speak. And it's one of our favorite statistics to watch because it could, a company could, theoretically buy out another company with free cash flow, right? High free cash flow tells us that a company is managing its money well. There's more cash coming in than flowing out, right? So balance what's going on with all of these different metrics and study how each one of these affects the company. And what I do is write a summary based on the company you're studying, maybe a paragraph about the expected growth in the stock based on your findings. Read what these stock analysis sites are saying about the same company and about these topics in the sector in which you're invested and the market at large. See if you can draw connections to similar companies or competitors, and then check the performance of other similar stocks, right? So if maybe there's an article comparing free cash flow of different competing companies. I was looking at fintech companies like PayPal and Square. Um, what is it? Alipay from Alibaba and Stripe. So they were comparing the metrics of these. That's good to know because if I'm invested in PayPal, for example, I want to know how they, stand up to companies in their sector, similar companies or competitors, right? Um, and similarly priced companies as well. And then look on the charts and see if the price action makes sense given these metrics. Like if a company is growing its earnings year over year, it's producing more assets, it's cutting down liabilities, the stock price should theoretically be going up, right? So remember, the overall economy can affect the stock price too. So if you're that, you might have a good company, but the economic environment is poor, and so therefore the stock is faltering, right? That could happen too. So also, if your analysis is inaccurate, do more research as to why experts think the price is moving the way it is, and then find the info you're missing. Okay. So here's an example of an income statement on Zacks, Zacks.com. This is PayPal. So this is kind of what these sheets look like. They're kind of boring. This one is showing a yearly income statement, but you can look at quarterly ones. But yeah, it has all the metrics we talked about. So they're boring statements, but look at the year over year growth of sales, of total income, marginal stuff, and marginal income and net income. Yeah. So not total income, net income. And you want those things to be growing, which in this case looks like net income is, sales is growing. So, just look through the metrics. But this is what an income statement would kind of look like. This is a balance sheet on Yahoo Finance for Apple. You can see assets, liabilities, equity, total debt, all that stuff, working capital. Similar, they're not exciting, but you want to see the patterns in them, right? Some of them have bar charts and stuff you can compare. And then this is a cash flow statement on Benzinga for waste management. This was actually clipped from, I believe, their 10Q form. So there's 10K forms, 10Q forms for annual and quarterly financial statements. If you look up the 10K form for a company, like an annual report, it'll have all these financial metrics in it. But that's very boring. But I mean, you could go on these websites and they have them in nice fancy fonts, especially Benzinga. Benzinga does a nice job of laying out the main metrics for each of these. But if you want to see the detailed, like 10K form, you can actually go on the sec.gov site and look up the stock you're interested in. But it looks like Benzinga clipped this from their 10Q form. So, and that's got operating cash and free cash flow and all this stuff. This is what it looks like. So balance sheets can make or break a future company prospects. So do your due diligence. It's worth so much in gold to look for yourself at the financial statements of the company, what you invested, and be able to gauge the health of that company. Hearsay is what it is. But if you've seen it for yourself and you've looked at the metrics, it's an extra layer of validation, right? And it'll prevent you from picking weak companies or I should say, it will prevent you from picking companies that might look good on the surface but have underlying problems or defects. So take this information, go research some of your companies. I would suggest like 4 or 5. You don't really need more than 10 companies in a portfolio, to be honest, especially if you're a new beginner investor. But practice this and look. I guess you could look up their competitors, look up similar companies, similarly priced companies, companies in the same sector, and practice looking through these statements, because you'll start looking for metrics and you'll start being able to compare and see what makes sense for the size of a company. Like if a company has a certain market cap, like what's its total equity, what's its total assets, what's its net income, how much free cash flow does it have? You'll start seeing these things and you'll be like, that makes sense. Or, I wonder why this one's so low, or I wonder why this one's so high. Like, PE ratio, all this stuff. So go out there, take a look at these company financial statements, and I'll see you all in the next classes. Take care.